Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Aloha, good morning, everyone. Happy New Year. Harold Green here at Bright Tree Financial Group. I hope you folks have had a fantastic holiday season and that your new year is off to a great start. This is going to be our first Market Minute of the year. And I'm going to kind of keep with the same theme that I had last year in terms of what we were actually doing, what things looked like last year, how it started out, and how it ended up this year. Or last year's performance is no indicator of how things are going to perform this year. But I do think there's going to be a lot of pushing and shoving, to say it lightly, between those who think things are going to go one way and those who think things are going to go the other way. You're going to hear a lot of market narratives out there. I think the Feds are going to come out today or tomorrow, I think, with their minutes for December. And you had some talking about 30 rate cuts. You have the market, or, when they say the market, I don't know who they're talking about, whether it's the market makers or who, but they're pricing in 6 rate cuts for 2024. And as history has suggested, when you have rate cuts of that magnitude, it means that the country is either headed into a recession or already in a recession. But me personally, I don't think there is going to be a deep recession. I think we've already been in rolling recessions in certain industries, whether it's housing, whether it's construction, whether it's communication services, whether it's, certain segments of the banks with the regionals and things like that. I think it's just been rolling all around because interest rates have hit each sector a little differently. And so I want to kind of give you a snapshot of how we started off last year and the reasons that I think it may have happened that way. So what I'm going to do is share my screen with you, and we're going to get right into it. So the first thing I'm going to take a look at is we're going to take a look at the bond yields. And bond yields are spiking again. They're going back up again. Some out there think that the bond yields are going to go back up to 5%. And I don't see that happening with the Fed cutting interest rates. Usually as bond yields fall, interest rates are supposed to go down with it. The federal funds rate is supposed to go down with it. So if we take a look at the history here, the last 6 months from July of last year, this is when the stock market crashed, when bond yields were just going up like crazy because the government had to raise money and they were borrowing trillions and trillions of dollars, and they had to pay borrowers a higher rate of return in order to take on the debt. And also you had inflation, all of that, right? So inflation was actually coming down, but bond yields were going up. So that's an interesting story in and of itself. And then you also had from October, when the inflation data started coming out cooler, you saw the bond yields drop, right? However, the Fed haven't cut rates. And so what this is you see the Fed's holding rates steady, okay, and then bond yields coming down because they do think that the Fed is going to cut rates. And so this is what's happened in the last 6 months. And so we got a little tick up here, and then I think it's going to start to tick back down. I don't think it's going to keep going up. And so as you can see here, it came down. We had to tick back up. That was scary. Came down, tick back up. So, we're stair-stepping our way down, just like we stair-step our way up. So stocks have reacted to this. And so as you can see, we had a big rally as the bond yields came down in October, November. Big rally, right? So I'm very thankful for that. And I think what's happening now, I'll get into that in a second. We look at our fear and greed index. It's still over here at extreme fear. We've had 2 really horrible days of selling. I mean, people sold off at the end of last year, taking profits, right? And then they sold off at the beginning of this year. I believe that was profit taking. Now, one of the things you have to remember, and I'm going to keep repeating this, when you see these massive sell-offs in the market, it could be computer generated. That feeds into human selling. And so what they do is the computers exhaust the market one way up or down. They do not care. They are emotionless. So they pick up on a narrative, they go until they can get every single penny out of that trade or that situation, and they do it the other way. It's it creates a lot of volatility in the market. So I just want you to understand that. Algorithm trading is not long-term trading. It's short-term profit driven with hedge funds and different things like that. They're talking trillions of dollars moving back and forth all the time. So what that does is it will cause technical selling. And so we're looking here at NVIDIA's cheat sheet. And basically, NVIDIA got up to $500 a share. And that's been their resistance for what? 3 times in a row now? We're coming up on 4 for a variety of different reasons. And so every time it sniffs out 500, it seems like it gets afraid of that $500 mark and it begins to just fall back drastically. And so that's what we've had. And now I like the position because of the long-term prospects, right? And so like in football, you can call the right play, but sometimes that play doesn't work because the other team has a better play. But I think we have the right play call for 2024 in all of our positions. And I'll just kind of go into that in a second. So again, resistance on these guys is up here, 508. I mean, if we can get past these, I mean, I think that we're off to the races, but that's going to depend on everything else around that. Now, so we're going to play this a couple of different ways. Okay. So we're going to stick with NVIDIA, but we're also going to basically add more into our AMD as well. And that's to kind of help out and offset any particular crazy things that could go on in NVIDIA because of their situation with China and the chips and things like that. They're going to be reporting earnings sometime in the next month or so. So that's another thing to kind of watch out for. But our options are for 2026. And so with that being said, for 2026, I'm going to go in here and look at our NVIDIA analyst targets. And I think they are the same, still $1,100 a share in the next 12 months. And the low is 410. The median is 654. And we're not even trading anywhere near that at all. 30 buys, 4 holds, and 0 sells. And so there's just a lot of like crazy things going on in the market that it's not allowing the market to operate freely as it should. So we're going to have to kind of wait this out a little bit. Now, let's go back and look at what happened in January of last year to February of last year. Okay, only a short month. And I'm looking at Tesla here. And so we know why they were driving Tesla down. That was all because of Twitter. Okay, that's no secret. And it got down here to being $108 a share, it was extremely oversold. And within 1 month's period of time, this position skyrocketed 47%. It was a feeding frenzy. People couldn't get enough of it. That was a huge part of how we rebounded our portfolios as well. Let's take a look at some of the other big ones. Apple, how did they start off? Down a little bit. Okay. Let's look at Microsoft. How do they start off? Down a little bit. We're going to go look at NVIDIA. Okay. These are our tech. Down a little bit. Off to the races. And in 1 month's period of time. So the optimism didn't start off right away. As you can see here, this up and down movement, it's basically the market, like I said, the push and pull. And then the one side won, and then we're off to the races. Now we can also look at like a Home Depot, see what they did. Okay. They were down there. And so this is where we get this push and pull and this tug of war. The AI thing was big and they just took off on that. I'm going to look at a stock like Costco and see how that performed as well from the beginning of the year last year. Not too bad. They were up 13% from that period of time. And then we're going to look at our Amazon. Okay. How did they do? Amazon, they were up 25% that same period of time. And then we're going to look at AMD. They were up 30% that same period of time. And let's look at General Electric. Basically, GE, they're down here at the bottom. So what tends to happen is, and I'm going to show you one more. Let's call it XLI. This is the Industrial Spider ETF. And they're the brown, and so they're down here at the bottom. So GE, there's quite a bit of companies in that Industrial XLI, that position. And I don't necessarily need to go out there and buy every single stock in that ETF. And so ETFs are a good way to kind of spread some risk around into a particular sector. We're going to go XLE, which is energy. Okay. And we look at that, same thing as down here at the bottom. So what was the beginning theme of 2024 Four. Well, it was because, I'm sorry, 2023. It was because things were so beaten up in 2022. The rotation happened. We came out of energy, we came out of industrials, and we rotated back to technology. That's just what the market did. And now we're having a similar situation where we look at how things are starting off year to date. Okay. Let's take a look now. We have XLE, that's up 1%. Everybody else, it's down. Costco is up a little bit. Well, they're still down. There's nobody who's broken this 0% mark except XLE. So the rotation was back over there towards energy, and it's probably industrial. So let's go XLI and let's see where that is. Okay. XLI, they're down a little bit. Okay. So I would suppose that it's a lot of technical selling, a lot of profit taking out of the key, the big ones that are sitting in there like Boeing and things like that, because they had a good run towards the end of the year. Let's go look at financials, which is XLF. Okay. That's a sector. And where are they at? They're down. So interesting enough, this is just year to date. Okay. And that's from the end of last year up until now. Okay. So we're starting a rough patch with a lot of selling. And one of the things that I'm watching is this going to be a long-term trend? Is it going to last more than 3 or 4 days? Where are we at right now? Well, it looks like things are changing a little bit, and some people are stepping up to the plate and starting to buy this dip. And that's very important. So it's 8:01 here in Las Vegas. So we're at the beginning of the trading day. And normally that's when you see a lot of selling. If things don't look well, it's at the beginning of the trading day. And then once all of the selling has exhausted itself in the day, you have people coming in to start picking up some of the pieces and then, buying down here at these levels, because I think NVIDIA, it's a good position to buy down here at this level, except for if you're buying the option, it's kind of very expensive. Okay. So I think for this year, one of my positions that I'm probably going to be rotating into the most would be Amazon. I really think that the story of Amazon hasn't caught up yet, because they're sitting down here trading. I think they're about they're about $150 a share. So I like to look at who has room to run. And Amazon, they're trading below their target of 182 and the bottom of 145. So we've been down here and we're just $5 off the bottom of Amazon. This is interesting. We're $5 off the bottom, and the median is 182, and the high is 210 over the next 12 months. And what do we have? We have 42 people saying buy, buy, buy. Like with everything you got, they're saying buy Amazon. This is what this means when you see a strong buy. Okay. Now, this is interesting because you got the fear and greed index over here. And as they say, when people are extremely greedy, you should be fearful. And then when people are extremely fearful, you should be greedy. However, that doesn't always line up, because if this was the case, the market would continue to sell until there's some bad news that would just like make people more fearful of buying equities. But they're not, because you got $3, $4, $5 trillion sitting in money market funds. Right now, they're getting 4%. But in an environment where inflation is still up at around 4 or 5%, how long can you sit there and wait on that? Depending on what your expenditures are and things like that, you're going to have to put some of that money back to work. So they're talking about, yes, going back to a 60-40 portfolio is good for some people, 60% equities and 40% bonds. I understand that. But in our situation, if our goal is to get between 10 to 20% a year on the portfolio, we have to do something a little bit different than the 60-40. Now, once we get you to where you need to be with all the money that you're ever going to need for the rest of your life, if we can do that, then a 60-40 might make sense. Or, some sort of play a rotation into, in and out of one sector into the other, in and out, back and forth. Or you can sit in CDs and rates are going to go down to 3% between now and next year. So that 60-40 is not always, going to work out the way they say, because looking at bond yields now, we're coming off the highs and it looks like the bond yields are retreating a little bit. And so if you're watching this video, depending on the time of the day, if you watch it in the morning, and then you open up your computer and then you watch bond yields, and then you kind of watch the correlation between the stocks and the bond yields, you can kind of see tech starts to recover when the bond yields start to retreat. And so we're having that situation happen right now with NVIDIA. And also as well as Tesla, they were off $11 a share this morning, which is horrible. And then NVIDIA was off, I think, 7 or 8 this morning. And then you can see things starting to kind of turn around. And then Amazon was down, but now they're on their way back up. And so I think this narrative is going to hold. And so that's, I wanted to put this out there and just kind of show you how we're starting off the year and why you see all the heavy selling. And again, it could be people are still on vacation too. Not everybody is back. And so once more and more people start to come back, you're going to see the volume change. And then all of a sudden they're going to look down here and see these prices are down there the way they are, and they're going to start buying. And so it's just what kind of happens going into the year. At the end of the previous year, we have a lot of selling sometimes, right? And because there's not enough volume, right? So if there's not enough volume, it looks bad, and there's no buying, there's only selling, then that just kind of accelerate things to the downside. And then when the market turns around, like when people come back, you start to see more buying and you begin to see less selling, and then it just kind of accelerates the market back up. So I'll say we're going to have to get through this week and see how it goes, see what kind of information comes out from the Fed, see what the Fed speakers say. You're going to hear a lot of talk. You may hear some in the Fed say one thing, you may hear some in the Fed say something different. But again, we're in an election year, and normally when we're in election years, the markets perform well. There's a lot of optimism going into that. And so let's kind of see how things play out. Now, the other fear that you might hear in the market is the situation happening with Iran right now. So they're attacking ships going through the straits. And I've gone through those straits several times. And it's a very scary situation when you're going through those straits. And you are on high alert all the time. It is 24/7. Okay. And for these ships that are going through there that are unprotected, that are now being attacked, it's a very, very scary thing. And so companies are now starting to reroute their ships from going there all the way down to the Horn of Africa and then back up. That's adding days and delays to our supply chain. And we can already start to see things being backlogged. We can start to see prices on things starting to go back up. And this is where they fear inflation is going to, rear its head again, because we're going to have supply chain issues and on and on and on. Going into a weakening economy, that may play a role. It may not, because if the economy is weakening and we have supply chain issues, then because the economy is weakening, then it wouldn't have exacerbated all that much. But if we're going into a hot economy and then you have the supply chain shocks over here and people still have money to buy stuff, that's going to cause inflation to go back up, right? Slowly, but it could. So there's nervousness around that. And so you're going to see some volatility in the market. But I would say overall, setting ourselves up for 2024, we have the right play calls with the right companies. We're going to be adding some more in there, and I've added some in there already. One of the ones you're going to see I have in there is PayPal, PYPL. I've added them in. And again, my theme is finding companies that are doing well, but they've turned it around, they've gotten beaten up. And so now they may be on the mend and bouncing back, and they're just overlooked, and so that's kind of like my theme. Now, there's not going to be big positions put in there. You'll see small positions put in there. And then you may have seen this position, GBTC, in your portfolios as well. And I like them. And over the last month, they've done okay. But over the last 6 months, they've done pretty well. You probably have seen this one in your portfolio at one time or the other, Marathon Digital. So they skyrocketed, but then they took a big hard fall in the last few days or so, and they got stopped out of your portfolios. And so they're not in there. So again, we're putting harder stops, closer stops, tighter stops on the positioning so that we don't lose as much when they do take these big, big hits to the downside, because again, the algorithms will accelerate and exacerbate that trade, whether it's to the upside or to the downside. And that's why you can see positions go up 100% in a day, and you can see some go down 20% in a day. I'm not saying in your personal portfolio, but just in the overall market, right? Some of the pharmaceutical things that we see have just it's been insane. And so there's a rotation going back and forth and back and forth. And so I'm not going to play that too much, because to me, you're chasing. And a lot of times when you're chasing, you end up buying in at the wrong time and then having to get out at the wrong time. And so it creates more losses than necessary. So we do our best not to chase, which is very important to me. And so I just wanted to kind of put this out there, let you folks know what my thought process is going into 2024. We're going to be watching everything really closely throughout the rate cuts and so on and so forth. And so I will be lightening up some of the positions in the portfolio going a little bit more conservative throughout the year, and some of the positions as we rotate our profits out of the high flyers like we did last year into either cash or TLT, TLH. You may see some of that in there. It just kind of depends on how things ebb and flow throughout the year. So that's pretty much all I have for you. We're fully back up and running from next week. I'm still working through some things. Beverly is taking care of some things, and she's actually on a trip and working from her trip. So we're staying on top of things, but we've taken a little time for ourselves at the end of the year, not a lot. And so we'll be fully back up and running on the beginning of next week in regards to operations. And so hopefully, if you needed anything, hopefully we provided it for you in a timely manner. And hopefully it seems like we haven't skipped a beat, which is kind of like how I like to run the company. I don't want it to feel like, oh my God, I got to wait 2 weeks. Oh my God, I got to wait I really don't want my clients feeling like that. So we do our best to, even if we're traveling or wherever we are, we do our best to make sure that there's, you're being taken care of. Okay. And it's not a stressful thing for us to take care of you. It does take time, and there's other vendors that may slow down the process, but we do our best to jumpstart the process for you as soon as we can so that we minimize the delays in getting service to you. So with that being said, once again, Happy New Year to you folks. And hopefully the information that I'm sharing with you helps you to understand where things are at and where things are potentially going to go. It doesn't, trust me, I understand it doesn't always feel good. It doesn't always feel good, but you have to understand that we have the right place called, and we're just simply waiting on things to be right for us. Now, if we look like if it looks like it's going to be wrong, then I got to switch gears relatively quickly. But I think today we may see the selling kind of ebb. Tomorrow you might see some selling, but by the end of the week, I think we're going to start to see some positive momentum in some of our positions, and that's what I'm looking for. So if you have any questions for me, please do reach out to me, shoot me an email. Love to hear from you folks. And then with that being said, I want you folks to have a super awesome year and much prosperity to you. So thanks again for allowing us to be a part of your team, and have a fantastic day. Aloha.
This is thepodcastfactory.com.